Thank you, Leon. I think we can go to the first slide. To the next slide, which is introducing our activities at Energy Investment Management. So as said also before, we are a small boutique consultancy with focus on energy transition assets and clean tech ventures. We have an advisory branch, a thought leadership branch, and an investment branch. We give advisory services related to all kinds of energy industry assets and ventures. We established multiple thought leadership programs that focus on not only the Eastern European energy transition, but also on the Indonesian energy transition, for example. And we do this by participating in various research projects, programs, networks, and other events, which like the ones we're having today. And we also invest ourselves with our investor network and also structure different portfolios or develop fund structures and different participation concepts. So this is the main things that Energy Investment Management is doing. You can go to the next slide. And here you can see just an overview of our programs that we're having right now. Mostly in highlight is this Energy Transition Entrepreneurial Opportunities Program that Denisa is coordinating. It also involves a research of mine, which is on the energy transition in Hungary and Poland. It also involves various cooperations with Enlit Europe. For example, an interview series that we're holding with also Eastern European young professionals, and various other initiatives involving other people as knowledge team or cooperations with different organizations, just like Energy Community. And again, various masterclasses and research programs that we also plan to develop further along the years as we ourselves dive deeper into the Eastern European energy transition, of course. And as you can see here, the red highlighted squares are the masterclasses that we have been giving in this series. So first of all, we talked about energy business portfolio strategy, mostly about the value creators and the businesses that are looking to expand their portfolios towards renewable energy, which will be very much needed in the transition. And then we talked about energy asset development, how you set up a renewable energy project, for example, let that be hydro, wind, or solar. And now today we're talking about energy asset finance, which is well, mostly about large scale, so utility scale financing of energy projects. This will be an important element of this session, but you can also see that we have various other masterclasses to give, also not just to companies or startups, but also to anyone interested in the elements of the energy transition. So we have a lot of knowledge still in our pockets, and we hope to also maybe share it with you as we go along. And now I'm going to give you a little introduction to the topic of today, connecting it with the energy transition and talking a little about energy finance. So here, this graph is, again, so there are so many good graphs to show that we are at the beginning of the big shift. So very exciting things are coming. There will be another 30 years of constant growth in the energy segment. But of course, it's different in terms of renewables than in coal, gas, and nuclear, for example, where you see a steady decline. And now it's upon us to choose who we choose, both in terms of investments and both a professional growth. I think we should all go for a sector that is growing instead of declining. So this is just to, again, introduce the scale of the transition that is coming. I think you can go to the next slide. So this slide is about the financing continuum of projects, which is basically about who finances what and when. So this financing continuum has made possible the growth of renewable energy around the world over recent years. And there's different type of investors that have backed technologies such as wind, solar, and bioenergy at different stages of their development. At the left side, you can see the early stages of the process where new technology has to be investigated and researched in a lab or a factory. This work may be done by the research and development departments of large companies or by entrepreneurial startups or public sector companies. But it needs to be financed, of course. And some of this money will come from government research programs and grants, and some from corporate balance sheets. And then moving a little bit to the right, there is the technology development stage, which can involve a range of different finance sources. Corporate R&D will still be involved in the testing and fine-tuning of new products, but equity contributed by venture capital investors will too, by backing young companies with a promising technology that they have developed. And then somewhat further along the line of maturity of the project, private equity investors are likely to come into to back growing companies. Private equity will typically put in larger sums of capital than venture funds, and will look to crystallize profits by selling shares when the business floats in the stock market or is taken over. And then public equity markets bring money from conventional institutional or private investors into the shares of renewable energy companies, thus enabling the latter to commercialize their technologies and build manufacturing capacity, basically. And then both private equity and stock market investors are often involved at the stage of rolling out the technologies into utility scale or small scale renewable energy installations. Typically, for example, for a wind farm or solar parks, some like 20 or 40% of the cash for construction and operation will come from these type of equity providers or from the project developer themselves, while the larger share will come from lenders, which are usually banks or sometimes also bond investors. And then on the very right side is the last stage of the financing continuum that deals with money and assets changing hands. Rather than the provision of new money. Projects such as wind farms, for example, are often refinanced once they're operating, so that the new owners can take advantage of a lower cost debt, or they may be acquired by new owners for strategic purposes, or because those new owners want to invest in operating stage assets, but not to be exposed to the risk that come from developing and constructing the project. So this was the financing continuum, and then we can go to the next slide, which shows us the types of global transactions in renewables. By the way, this is a very good report from UNEP and the Frankfurt School and Bloomberg New Energy Finance, which we took the graphs from. It illustrates the scale of the different elements of the financing continuum in 2019, so 2020 is not included. At the left, you can see the scale of venture capital funding, government and corporate R&D, and public market investments, which produced a total for company and early stage investments of about $23 billion. Moving further to the right in the figure, there's a relatively small adjustment for reinvested equity. This is basically money raised, again, by public markets or from private equity that then finds itself going into the construction of new renewable energy capacity. And then there are the two largest aggregates, so asset finance and small distributed capacity, which is mostly solar systems, which takes a charge to a whole new investment level on 2019, which is about $201.7 billion US dollars. And then finally, on the right, there's a column for acquisition activity, which are asset purchases and refinancings plus company takeovers or buyouts. And adding this to the new investment total takes us to again, a very big sum, $402.4 billion for the value of all financial transactions in the sector, basically. We can go to the next slide. So now we hopefully got interested a bit in asset finance, which is exactly what this session is about. It's not about venture capital or private equity for companies, but financing utility scale renewables. And Leon later will also talk a bit more about balance sheet and asset-based finance, but this is maybe a small intro. So this figure highlights the two main ways in which projects are financed, either on balance sheet by utilities, energy companies, and developers, or on a non-recourse basis, on a project basis by a special purpose vehicle or special purpose company, as we call it. Which is set up for that specific project, and this is then called non-recourse based finance. So in the first approach, the company or companies that own the project may raise a bond or another debt finance to help pay for the construction of the asset, but this will be done via their own corporate balance sheet. So they will therefore bear the whole risk of the project execution. And then in the second approach, the developer is likely to own all or part of the equity in the special purpose company, but this will usually be supplemented by the raising of a debt, so that only a proportion of the project risk will reside with the developer. And in both cases, in both financing cases, the project may well be refinanced once it is ready and operational, since the financing terms available at this lower risk or like end stage of the life of a renewable energy plant is usually much more advantageous than to those available pre-construction. In 2019, as you can see, balance sheet financing made up to 65% of renewable energy assets and finance, while non-recourse or project-based finance accounted for 35%. And the bond or the other category, which includes leasing, also continued to be just a tiny proportion of the total. And the split between balance sheet and project-based finance has always favored the former, so balance sheet. This is partly because many of the largest investors in renewables are utilities or independent power producers that prefer to take this approach for ease to ease the execution and then possibly refinance the project later. And also the project-based structure that is very familiar in, for example, Europe or North America, China, may also be less easy to adopt in newer markets where the risks of the execution are less well understood by domestic or international banks. We can go to the next slide. The last one, so this is about the acquisition transactions in renewable energy per sector. This graph, I think, shows very well how in recent years activity has become increasingly concentrated in wind and solar, of which the volume is constantly growing and is a major business now. In 2019, they took almost 97% of the total, which was a slight increase on the year before. And among the remainder, a little bit less than 2 billion was recorded in biomass and waste to energy projects, for example, which is a record low for this sector, while less than 1 billion was seen in geothermal or small hydro and biofuels. So there's a clear contrast also between the two biggest sectors in 2019. So while wind activity remained very high, solar plummeted, interestingly, to its lower level since 2013, as you can also compare it with the graph of that year. So it seems like the big solar deals that characterized 2018 were already absent in 2019, but it would also be very interesting to see the 2020 figures, in my opinion. And now I would like to bring you, give the floor to Leon and give his presentation about asset project finance.
Yeah, thank you, Chinska. Thank you for the introduction. I think it gave quite a good overview how that project finance industry in that renewable energy has been growing over the years. And I still remember the early days when there was project finance. Project finance is there already for ages. When you think about toll roads or public housing in the UK or and mining activities, there was already always project financing, but for renewables, I think it's there now, so 15 years maybe. And the beginning it was really quite a challenging industry because the ticket size was small compared to other public project finance activities, like, for example, toll roads. And now you see the business, the energy asset project finance, really getting more mature. And of course, different markets have different perspectives, but I think it's quite a big industry at this moment. And as mentioned already last session, I think it's also learning a new language. That financing language was also new for me 10 years ago. And it's like with every new language that you learn, you have to practice. And just by trial and error, you will find out. And of course, you can also learn from other people. I did some project financing courses in the past, and that really helped me forward. But I think mostly you learn also in the field. And here you will find some terms, but there's much more about project finance also, for example, on Wikipedia. Just feel free to have a closer look there. When you look at project finance, I think it's a financial structure where the lenders have recourse primarily to the revenue streams of the project or asset they are financing, rather than on the balance sheet of the sponsors. So normally most financing, I think, is balance sheet financing, and then You look to a company and look to the forecast of the company and how did it the last years, and based on that you can get your loan. With project finance, quite different, and the balance sheet finance I just explained, but also there's something like asset-based financing. For example, airplanes or production lines are typical asset-based financing. That is kind of equipment you can also sell to someone else, and then in that way it's mobile. A project is most of the time it's difficult to bring to another place. So it's much more the project and the project contracts that creates the value and that secure that revenue stream. So that makes project finance. When you look to energy assets, and here I have some nice pictures of energy assets. Solar field, wind turbine project, biogas installation, and a quite innovative project, a kind of underwater kite. Then from a technology perspective, they look quite different. From a business perspective, economic perspective, there are quite some things the same. And of course, more mature technologies like wind and solar are quite easy to finance when the projects are developed well and the circumstances are okay. I think when you look to biogas, then it's already a little bit more challenging by reason of the feedstock. You most of the time getting feedstock contracts for a longer term can be quite challenging, a little bit depending on the location and the network partners, but that's one of these elements that makes biogas projects more challenging to finance than wind and solar. And quite innovative technologies. Yeah, then I think there are project finance solutions possible, but it will be much more challenging. And of course, then it's always good to understand what kind of other concepts are available. So we are also happy to share them some more insights, for example, about financing startups that we still have in our Masterclass series. We look to a more the economic view, and last week we already spent some time on this special purpose company project entity. This is a visualization of a project, for example, a wind energy project where you have your contract to develop the project, your building contract, your operation and maintenance contract. So during your development, you will agree these contracts. You have your subsidy agreement, your insurance for your building stage, operational stage, your land contract, your permits, but maybe also kind of tax incentives from the government, your power purchase agreement and services, for example, the road to the wind turbine and that kind of things. And when you have a wind energy project, then 20% of the investment is coming from the investor or the project developer in the form of equity, and 80% is coming from the bank. And with solar, it can even be 10% equity, 90% from the bank. Biogas can be 30% equity, 70% from the bank. So the bigger portion is coming from the bank, and for that reason, the bank is quite critical on the agreements that you made and the permits, for example, that you have been granted for financing this project. And of course, they will bring in a lot of money to an interesting interest rate. They will really create a nice leverage for the equity investor, but they are also very critical on the conditions of these agreements and contracts. And sometimes people think, project finance, that's about money, but I think the legal part is maybe even bigger than the financial part. As explained last week, and also available on the website of Energy Community in a video, it's about project development. So step by step, this project entity will be developed. So in the scoping phase, you will have your permit, you will apply for your subsidy, and in the definition stage, you really develop and negotiate all the contracts. So at this moment, final investment decision, your project is fully developed and ready to start construction. And it's also called sometimes financial close, the moment that there's commitment from the bank and other investors to invest. And I think a well-developed project development approach helps you to to come to a financing part. And there you also see the difference. I think, for example, for a wind project, this whole process till the moment financial close can take 6 years, 8 years. The financing most of the time only takes half a year, 1 year. So the financing is a small, from a time perspective, a smaller part. And when you do your development well, then projects are also more easy to finance. What's good to understand that different types of money have different risk appetite and have different required returns. When you look to senior debt, then the required return is low, but also the risk is low. And you compare that with equity, where the required return is high, but also then also the risk involved are also higher. And of course, there's also something in between equity and debt. It's called mezzanine or preferred equity or junior debt. And that's a little bit a mixture of risk and returns when you compare it with the other types of money. And it all has to do with security. So the bank will give that big loan when you also have a way of security in your contracts that in the end the bank can secure its position to what is reasonable. And that for me was quite new in the beginning, that a party that you spend a lot of work on your project development, but in the end there was the bank that was always very critical on conditions and want to have a very safe position. A little bit longer in the business, I also understand that in that position, and when things doesn't go well, then of course they have to have a kind of security. And for that reason, I now much better understand their position. When you look to the different views, I think then it's quite interesting when you look to financiers. So they say, is there enough money available to pay the debt service? In the end, that's one of the most important points. Is there enough money coming from the project over the years to pay interest and debt repayment? And then taking into account project costs for development, realization, operations. And of course, that's a little bit the main question, and we will dive more in detail with some examples that also will Denise explain more in detail. And of course, you have to give confidence that you have mitigation measures for risks that limit that project revenues. And that can be in that project realization stage, but also in the project execution stage and the operational stage. So every time it's looking at risks and looking at way to mitigate risks. And there will Denise give us some more insights. Return on equity, I think, is also important when there is less return on equity or less than expected, then the bank also doesn't feel comfortable, because when the shareholder doesn't get his expected returns, then maybe he will also not care as much for the project as he's supposed to do. So also a reasonable return on equity is also very important for the bank. When you look to the two different perspectives, so one is the debt provider and one is the equity provider. And you have a wind farm where you have a certain amount of sales revenues from your sales of electricity, your subsidy. You have your operating cost, and then you have amount available for debt-related cost, and the rest is available for the shareholder for dividend payments and reserves. And the debt provider will look at it as, is there enough project revenues to pay my interest and debt repayment? An important criteria is debt service cover ratio. I'll come to that later in the next slide, some more in detail. It's a very important criteria in the evaluation the bank is doing. And you look to the equity provider. Yeah, here's a different view. He's much more looking to the project lifetime. So when you have a longer project lifetime after your loan lifetime, it's called the tail. When this time frame is longer, that also helps you to be more secure, to generate more income over time. And yeah, the main criteria is IRR for the IRR on equity. That's the main criteria for the equity provider. And when there are possibilities to have a higher loan and to have a higher debt related cost, but in the end there is a better project IRR, yeah, for most financiers, for most investors, that's okay. That's the way it works. Financial modeling. We spoke last week. We spoke a lot about project definition, how to develop a project. Now we spoke a little bit more about project cash flow, the project vehicle, how to create a business case. Some more about that in a minute. And then it's about funding, how funding is arranged. How do you find the right financiers for your project? And there you will also see quite a wide range of financiers that you can be involved. And I think when you understand your project very well, when you understand your financiers, then it's also more easy to arrange funding. As said, quite a big part of the work is legal work, but there's also, of course, financial modeling. I think the FAST modeling standard, and you can find some more information online. There's also a 31-day financial modeling course. I think only 10 minutes a day or half an hour a day will really give you all the details about financial modeling. And I think said about using the financing language. I think using modeling standards also help you to communicate with other financial professionals, with banks, with investors, and you build your model in a way according to the FAST modeling standard that really helps you to communicate about financial models and how you look at revenues. So yeah, I think have a closer look at it, and we're also happy to share some more details about financial modeling, maybe in a next masterclass with energy community. Banks, investors, funds, credit agencies. So there are a lot of ways to get money for your project. And it's quite a whole spectrum. We look to European EBRD, European Bank. I think it's an important one. We look to Eastern Europe and look to Southeastern Europe, energy community related countries. IFC, I think also important financial institution. Then on a national level, like in the Netherlands, you have FMO, that's the Dutch Development Bank for developing regions. And then you, in that public area, you also have organizations like KfW, also a kind of bank. AKF it's a Danish credit agency. So when you buy wind turbines in Denmark, yeah, most of the time AKF is also helping you with the financing solution. Then you have more the investment funds like Impacts, Foresight. I know them from 10 years ago. They at that time they were just starting in the business. I think 10, 12 years ago. Now they are quite mature. UK-based funds, especially focusing on renewable energy. Dutch Infrastructure Fund, it's a Dutch fund. Recently did quite an interesting deal in Poland. And also, for example, you sometimes have very specialized funds like Norfund. It's more focusing, for example, on hydropower. So funds are quite internationally. Banking is more locally and sometimes also backed up by international banks. For example, Raiffeisen Bank is quite a strong bank in the Central Southeast European region and is backing up local banks and helping them also with expertise. And another important one is UniCredit, Italian bank. I think it's also quite internationally active, especially in the region that we are talking about today. And then you have something like it's more called how's it called in technology or industry finance, like Siemens Financial Services, also an example where technology suppliers also help the projects where they deliver technology. So you see quite a wide range of financiers, and it's good to understand that these different types of financiers have different requirements. Some fits better to one project than another, and it's good to discuss to really find out for your project what are the most suitable financiers. A little bit more about the value creation, also explained last week. I think during the development you really create value, and especially at a certain moment when you have your permit, then the value is really going up, and permit subsidy are important elements. And what you also see that quite some projects are not financed once, they are financed several times. For example, what you see is at 70% development, so you have your permit or you almost have your permit and you still need a year of development, then other type of investors you can get on board that are more entrepreneurial type of investors. So they understand project risk. They also understand that you're not at financial close, but they also have a quite a higher return expectation. Then of course you have financiers that like construction risk, so they're happy to take construction risk, but they also like higher returns than only operational projects. And then of course you also have investors that really like very predictable projects. And most of the time when a project, a wind or solar project, is operational, for example, for 2 years, 3 years, then it's quite predictable. And at that moment, it can be very interesting, for example, for a pension fund. And there you see quite lower returns. Here I mentioned 8 to 11%, but it's also a little bit depending on the country that you're in. For example, in Germany, you already see operating risk or low infra IRRs of maybe 4-5%, sometimes even lower, a little bit depending on the type of project and the region that you are investing in. So it's good to realize that most time it's not one time the financing. No, there will be several transactions, as also Chinska already showed in the graph, especially that transaction area is quite big and also an interesting area to work in. So that's a little bit the overview about the project financing. I also realize there may be a lot of new things, so feel free to ask questions also after the session. Tanisha, can you take it over and give us some more insights about 2 cases that we like to share?
So hello again, everyone. Now, in this last part of today's presentation, we're going to talk a little bit about risk assessment and all the financial risks that are basically part of the projects and how this risk can be mitigated. And after that, we're going to talk about the most attractive part, so to say, the money. Where does the money come from and how it is distributed along the years. So whenever you are working on such a big project, as Leon and Chinska both mentioned before, it's quite important to realize that the bank somehow or another financial institution has to be one of the major shareholders, because they are the ones with the finances, and otherwise you cannot get such large amounts. For instance, a hydropower project in Albania is worth 30 million euros, and then you need that capital to actually start working on it. And the way to secure it is, of course, by working closely with banks. Leon, if you can go to the next slide, please. So yeah, as we said, there are a lot of different risks, and last time we actually mentioned the risks that come based on the location of the place, especially if you are working on the project that will be built on land that belongs to the people or in the middle of the nature. That is also quite problematic. And apart from that, of course, you have to consider the financial aspect, like upon finalizing the project, will it actually generate sufficient profit throughout the years? Leon, I think you can pass 2 slides right now. Yeah. So as we said, these risks have to be mitigated somehow, and there are some certain measures that you can take, which we will be giving you some information about now. But apart from these ones, you can also do your own research and see some other mitigation measures that you can take. Let's start with one of the risks being the risk of completion. So in a lot of cases, you have different projects that don't clearly say when the project is going to be considered as finalized. And that's, of course, an issue because you have shareholders that are waiting for their return, so to say, the banks that are also waiting for their money back for their interest and also principal payments. So when you say that a project is completed, you have to specify whether it is completed when you finalize the construction or it is completed when it actually starts working. So that is something very important that you should do in all the contracts and everything that you sign. And some of the things that you can do to also mitigate such risks, apart from clearly specifying, is to have different contracts in place, which we'll touch upon in the upcoming slides. Leon? It's always a bit difficult to coordinate with the slides, yeah. So there are some different categories of risks, of course, and you have the operating risks, which is always related to the costs that you will be spending. So you have to think about the raw materials. You also have to think about the transportation. Is it feasible to get everything into this location? How will everything go there? What raw materials are needed? How much do we spend for that? This is one of the biggest risks and also gives a lot of uncertainty. Another part of this uncertainty and risk is also the lead time, especially if you are bringing materials and employees from other countries. You really have to think about the lead time. Will everything be delivered in time? Because we all know, even when you are building a big building in the middle of the city and when you are working with such big projects, the time when you actually finalize the project is never the one that you estimate that you will be done in. So this is also something to consider. And you have market risks. There can be a lot of big competitors already in the place with established contracts. And of course, a lot of the businesses that are working with these other companies or projects are not willing to switch because they have been working together for quite some time. And you also have the political risk, which is how is the political climate? Is this project going to be backed by the government or not? Especially in Eastern European countries, being maybe a bit smaller than Western European countries, having a smaller population as well. The politics kind of dominate this aspect, the energy aspect. The government is somehow always there. So that's also something very important to consider. And yeah, Leon, I think you can go to the next ones. Yeah. So in order to kind of get rid of these risks, you have to do due diligence. And you have to do this before signing the contracts, before starting to work. There are, for instance, market risks, and the way that you can put this market risks to bed, so to say, is by constructing some power purchase agreements, which are basically agreements that you have with different businesses, and that they explicitly state that they are going to be buying electricity from you once the project is finalized. So that's something quite good that also will help you in the future. And also something quite nice, but also tricky in terms of businesses, the take or pay contracts, which is basically you sign a contract with a business that they are going to get electricity from you, And in case they do not purchase this electricity from you, they have to pay you a fee because they have wronged you in some way. So this is also something quite good that you can do to know that you are starting off strong. Apart from that, of course, as we mentioned before, you're always going to have the risk of not being on the side of the people, or having the local government against you, or maybe the people against you. So these are some things to consider. And of course, when it comes to the climate, you have to be very careful about the policy, and maybe also take into consideration the fact that not all of the countries are super prone to making everything green, but that is of course changing with the Green Deal and all the initiatives started by the EU to switch. Leon? Yeah. So we have talked a little bit about hydropower, a little bit about solar panels the previous week as well. But this is also the time to talk about wind energy projects, because they are quite similar in terms of development, and also in terms of financing. So here is also what you can see as the risks. You can also go through the slides, because everything is kind of elaborated throughout the presentation, but you can see that you have the regulatory risks, environmental risks, financial risks, and construction risks, just like with every other case. Leon? Yeah. So as for renewables, it's usually the case that you have some sort of seasonal output, so to say. And this is also the case for wind energy production. So you can see here from the graph, you can see depicted the weeks of the year, and also how much wind, the speed of the wind in different periods. And then you can see that in summer, starting from maybe spring, there is really not as much wind. And then in winter, you have this bigger periods of flux. And depicted in the next graph, Leon, if you can go again. Yeah, this is again depicted in the next graph, in which you see basically how the wind energy production is kind of distributed. So it's not always the same, and you have always those peak times. Yeah. But also something quite interesting to mention here is that you can see, like, for instance, the power that can be generated by a wind turbine. And at some point, when the speed gets too big, you kind of have to stop and halt the production of the electricity from this turbine, because to kind of mitigate for the risks of the equipment, because some equipments can be damaged, and then you really don't want that to be damaged. But that also hinders the electricity provision. So it's kind of, so to say, a give or take situation. And now when it comes to the energy yield, which is the part that the investors and the shareholders would be the most interested in, it's basically how much energy these turbines can produce, and also how much a whole plant can produce. And this is of course based on the geographic location of the place, because it's very different when you have something located in a place that it's not super windy, and then you have a complete different amount of output when you are placed in a place that is consistently windy throughout the whole year. So that's also something to take into account, because when you are in meetings with shareholders, you're going to have to convince them that this is a project worth working in. And if they say, oh, okay, but maybe a wind project in Spain, it's not as interesting because there is not so much wind there. And you have to find a way to convince them and say, okay, but in this location, actually, historical data shows that there is a lot of wind throughout different periods of the year. So another thing that is quite important, like this, we really have to stress this out, is that whenever you are in meetings with shareholders, you have to show them numbers. And these numbers basically have to be based on the P90 and P50. So usually investors are more likely to invest if you show them good P90 values. This means that basically you make some estimations on the internal rate of return. And then P90 means that you are 90% likely to actually have this happening upon the completion of the project. Whereas P50 is basically, I'd say, 50-50 chance you don't really know well. But the thing is, you're going to see also in the upcoming graphs that P50 has more attractive values. And a lot of people can be lied by that, but then you don't really have that sort of clarity. It also brings forth a lot of uncertainty with it. So investors usually look at P90 because they want security and they really want their money's worth in the end of the day. Okay. Another thing that investors will look at before deciding to go on with the project and saying yes, it's going to be the debt service cover ratio. And in more business terms, this is basically how much of the operational expenses of your company can go to making up for the debts that you have. So you make a profit in the end of the year, and then how much of this part is actually going to go to paying the debts, and do you have that capacity to pay the debts? So it's really about the capacity that you have, or maybe you even don't, and in that case they won't invest in the project. Now you can see a very realistic graph depicting how basically the financing part goes. You get a sufficient amount of money from your shareholders, and then you have to pay back interest and repayments. I see we're getting some comments. I think we can also answer the questions after in the end of the presentation. But yeah, here you can basically see that you have a huge amount of interest and repayments, at least for the first 15 years that the project is ongoing. And this is, of course, because you're having a lot of external financing because the projects cost so much. So for the first 15 years, you have to make sure that you are paying everything back. And the dividends are also something that the shareholders are quite interested in. But of course, if you are not, if you haven't paid back the debt, then you cannot give big dividends. So the dividends are quite small in this first 15 years. And you can see then that the amount of dividends increases by the increase in the blue. If you go more to the right of the graph, as you have finalized with paying back your shareholders in terms of interest and repayments. And this is usually banks, basically. Leon? Yeah. So here you can see what we were talking about before, the P50 and P90 based in an annuity profile. And later on, we will see how it is in a different case. But as we said before, P90 looks less attractive than P50. But still, the shareholders are going to see the P90 values. And if these are attractive to them, if you have sufficient proof that this is going to be the case, they are more likely to invest. But they will do no comparison with P50. It's just basically what they're going to see when they look at the project. Leon? And yeah, here again you have a different way of payment, which is basically a sculpted repayment profile. And then you can see that P90 increases in this case. So like the internal rate of return is bigger, which gets even more attractive for your investors. So yeah, this is probably also something they would be very interested in seeing, and this is also something that would be more profitable for you, of course, because parts of this return will also go to you and the company that is developing this as a project.